My name is Bill Kreitz. I'm with the Hampson-Meyer Kreitz Agency, and we're proud to be one of the co-sponsors of this event today. I'd like to welcome all of you and thank you for taking the time out of your busy schedules to join us. We hope to make this a very meaningful presentation for everybody in this room. Over the last several years, we've sponsored literally dozens and dozens of seminars, both for our customers and for the general business community. And I've got to admit, the response to this seminar has been outstanding. It really has shown a great deal of interest in the subject. And when you consider that the healthcare system is about 1/5 of the total U.S. economy, and every man, woman, and child that lives in this country will be affected by this new law, I can understand why the interest is at the level it's at. We've put together a presentation with a number of folks here that are experts in the field. There's a law that they're going to talk about that's about that thick, I don't know, 10,000 pages or something like that. So these folks hopefully are going to simplify it for us all and tell us the high points, because everybody in this room is going to be affected by what is being discussed today, individually and as an employer. So I'd like to now introduce Bob Oster. Bob is President and Chief Officer of Kincannon Miller, a CPA firm, and our co-sponsor.
Thanks, Bill. I want to reiterate what Bill just mentioned about welcoming you all here this morning, and we have another session this afternoon. We're going to have over 200 participants by the time the day is over. So obviously this is a piece of legislation that is important to everybody. We're happy to be here, glad you could make it. I suspect that by the end of today's presentation, there will probably be as many questions as there are answers. And it's very important that you keep in touch with your professionals, your CPAs, your lawyers, your insurance brokers, et cetera, and keep everybody in the loop as this law progresses and as the regulations continue to come out. Partnerships like we have with HMK for programs like this are great for us as an organization, and I think it's great for HMK, but maybe more importantly, it's important for all of you folks to get professionals like this together, to put a presentation together that really is going to be helpful to everybody. We're happy to have you here and take the time to meet with us today. Hope the information is important, and I encourage you to ask questions, both today and in the future. And at this point, to get the program started, I will turn the podium over to Todd Lynn, the manager of Hampson-Meyer Kreitz's Group's Benefits Division. Todd.
Good morning, everyone. Good morning. Thanks for coming out on this foggy morning in the Lehigh Valley. And what better way to spend your morning than talking about insurance and health insurance reform? So we are going to read the bill page by page. So we'll take our first break at noon. But seriously, the Supreme Court ruled, and now what? What do we have to be ready for? Consultants like myself, experts in the field have probably told you over the last 2 years, most of the regulations don't happen until 2014. You have plenty of time, and the states are suing. Wait till the Supreme Court comes out, and we'll just put everything on the back burner. Well, now the 2014 is right around the corner. It really is. So we're going to go over some of the major components. We cannot go over everything that's in the bill. I'm not a prop guy, but here is the original copy of the reconciliation bill. It is 4 pages, copied front and back. I have read it twice. I know I'm crazy, Tony, but 50 Shades of Gray doesn't do it for me. This is the easy read, believe it or not. There have been regulations coming out from Health and Human Services, IRS, U.S. Preventative Task Force, weekly. and to really keep up with all the regulations has been a daunting task. So before we talk about what's around the corner, let's take a look at the landscape. You know, what has happened since 2010? First thing that came out was grandfather status. Am I going to keep my grandfather status? What is grandfather status? I'm not even a grandfather. And basically, HHS came out when the bill was signed and said by the time after 2011, 78% of businesses will most likely keep their grandfather status, and about 60% at the end of this year. The Willis Group, which is a large national brokerage firm, surveyed all of their clients. I also seen a similar survey from Mercer Health Plans. And as of 2011, less than 1/3 of companies have kept their grandfather status. So is that good? Is that bad? There were some good components. Unlimited lifetime maximums, dependents up to age 26, and I think the carriers struggled with that early on. How do we rate that, or is it going to be single coverage, is it going to be family coverage? But we worked through that. No pre-existing condition exclusions for children, and the additional cost was approximately about 2% additional premium to your health insurance premiums. So not a big deal, a lot of good things in there. Shortly after that, we saw some other provisions come into effect, preventative services at zero copay, and direct access to OBGYNs and pediatricians. So some good things that are in the bill, but everything that we keep giving away, you know, there is some cost associated with that. The next was the small business tax credit, and I'm not going to steal Kincannon Miller's thunder, but when we dig into it, it's really a tiny business tax credit. Very restrictive as who is eligible, and then with all the phase-outs, you'll see it really didn't put the financial impact, I think, that the feds expected. Probably something that hasn't been getting a lot of press, but probably has had a lot of effect on the small, mid-sized market. It has been a crazy year as far as premiums and renewals, is minimum loss ratio. As of now, depending on whether it's small or individual plans, small group or individual plans, have to run at 80% and 85% for medium to large. And basically what that is the carriers now have to spend 80 or 85 cents of every dollar that comes in on claims or claims expense. So again, is that good or bad? Only time will tell, but the feds are now regulating gross profit of the insurance companies. This past month in July, the first wave of rebates went back, so if you run better than that 85 or 80%, you have to give a rebate back to your clients. And HHS has a lot of regulations on how those need to be dispersed back to the employees, whether that's cash or offset future premium increases. So again, you know, only time will tell what's going on. Today is an important day with healthcare reform. Starting today, all new policies and renewals thereafter, women's contraceptives, all FDA-approved women's contraceptives will be covered at 100% with no copay. So whether you're pro-life, pro-choice, as business leaders, you just have to know that there's going to be some costs associated with this. WebMD is great. The average generic cost for contraceptives runs anywhere from $22 to $261, depending on the type. If it is free, brand name drugs on average are about triple this. So we don't know what the cost is going to be, but there's going to be some additional cost to future premiums with the regulations. And then last but not least, a little over a month ago, Supreme Court ruled that for those that do not comply with the mandate will now pay a tax and not a penalty. So what better way to segue into Kincannon Miller is to talk about taxes. So I want to introduce Milan Slack, is a senior manager in the tax service division of Kincannon Miller. Milan is a CPA and a member of the Pennsylvania Bar, and he has over 16 years of experience. And Tony Deutsch, who is a shareholder with Kincannon Miller. He has over 29 years of public accounting experience. He has lectured on federal, I know he doesn't look that old, does he? Tony has lectured on federal and state tax topics before businesses and professional associations. I had the pleasure of seeing Tony speak at Healthcare Summit for the Chamber last year. You're in for a real treat, so let's give a warm welcome for Tony and Milan.
Thank you, Todd. My hairstyle's a giveaway. Okay, we're going to cover the tax provisions that are in the healthcare bill. This is going to be an overview. There's no way we can go into all the details. Quite honestly, all the details aren't even in the regulations yet because they haven't written them. So we're going to do our best to cover the provisions that are in the bill and give you a good overview. From a tax perspective, this health care bill is going to affect every business owner and individual taxpayer in this room. It actually started in 2010, and it's going to continue for the next several years and beyond. So as a business owner, you're going to need to comply with new W-2 and other reporting requirements, complicated tax credit calculations, and determine whether or not the cost to provide health insurance for your employees makes more sense than paying now a tax for not providing the insurance. So as an individual taxpayer, you're going to see additional taxes such as the 0.9% Medicare surtax on wages and self-employment income. There's an additional 3.8% tax on your net investment income, which is interest, dividends, capital gains. There's going to be a limit on the amount you can contribute to your healthcare flexible spending account, possible penalties for not having health insurance, but that's not a penalty anymore, it's a tax. And for those of you who like a good tan, you're already paying 10% excise tax on your indoor tanning services. So what this all means is that it's, as Bob Oster said earlier, it's really important for you to stay in touch and consult with your professionals in this area to make sure that you're doing the planning and getting the best benefit that you can for yourself and your business. So what changes in this bill have already taken effect? Well, there's been a few. In 2010, the adoption credit that was in place, they increased the credit for an eligible child up to $13,170. Medical benefits for adult children under the age of 27 is deductible by the parent. I mentioned a tax on indoor tanning services. And the one that Todd mentioned, for small employers, there's a health insurance credit that's available. And you can claim a credit up to 35% of the cost of providing health insurance to your employees. Now, how does that work? Well, a small employer is somebody that has 25 or fewer full-time equivalent employees, and their average wages for those employees cannot be greater than $50,000. Well, what does that mean? Well, a full-time equivalent employee is basically, the way you calculate it is you take all of the hours worked by all of your employees. You can exclude seasonal employees, which are those that work less than 120 days a year, and you divide those hours by 2,080. That's how you calculate your full-time equivalent employees. Okay, and then your average annual wages, you take the total wages paid to all those employees, and you divide it by the full-time equivalent. So that's how you do the calculation. But there's a phase out. Basically, if you have over 10 employees or your average annual wages are over $25,000, you start losing the credit. Okay, and as Todd said, it's for very small employers. So if you have 25 or more full-time equivalents or your average annual wages are $50,000, you don't get any credit. And once you're over 10 full-time equivalents or your average annual wages are over $25,000, you start phasing out the credit. So, and beginning in 2014, that credit is scheduled to go up to 50% if you qualify. So those are the changes that took effect in 2010.
Thanks, Tony. Good morning, everybody. So some changes that already took place in 2011. There's 3 of them here. The first is there are no more tax-free non-prescription drug reimbursements. So over-the-counter drugs and prescriptions are no longer reimbursable under such plans as flexible spending arrangements, health savings accounts, HRAs, and MSAs. Also, if you do take a non-qualified distribution from MSAs or HSAs, the penalty for that non-qualified distribution has gone up. It's gone up from 10% to 20%. And third, there's a new offering for small employers. New simple cafeteria plans are available for them. Small employers being employers that employ 100 or less employees. Now, for this year, 2012, there were 2 changes. One is still in effect, and the other has been repealed, fortunately. The first is for W-2s. Employers must now report the value of employer-provided health insurance coverage on every employee's W-2. Now, this is just informational only. It's just information put on the W-2. It doesn't mean that taxable wages or taxable income are going up. It's just informational. And second, fortunately, this has been repealed, but businesses would have had to issue 1099s to every corporation that they paid $600 or more of value to. And that would have caused quite a headache, but fortunately, that provision's been repealed.
Okay, now for the changes that take effect next year in 2013. The contributions to your flexible spending account for healthcare, there's a cap on it of $2,500. Prior to 2013, there was really no limit. The only limit imposed on it was the limit put on it by your employer under their plan. So that cap is going to take effect next year. Deduction for medical expenses as an itemized deduction on your individual tax return. For anybody under age 65, that phase out goes from 7.5% to 10%. So it's going to be harder for you to get a deduction for your medical expenses. There's also an excise tax of 2.3% imposed on manufacturers, on the sales of medical devices by manufacturers. That's really, unless you're in that business, it's really not going to impact you, but that takes effect next year. Now, the last one on the slide here, the Medicare surtaxes. These are the bigger ones that I think are going to probably impact everybody in this room, potentially. There's a 0.9% additional Medicare tax on wages and self-employed income, and that's on the employee, not the employer unless you're self-employed. And there's also a 3.8% Medicare surtax on net investment income. So those are the big ones, and we're going to talk a little bit about both of those in a little bit more detail.
Okay. So again, 2 surtaxes. The first one we're going to talk about is the surtax on earnings. Okay, this is a 0.9% additional tax on wages, bonuses, self-employed earnings. And the way it works is this. It's calculated and collected on people's individual income tax returns, all right? But it only applies once people reach a certain threshold of income. Now, for single taxpayers, what does that mean? If you file a tax return and you file it as a single person, not married, once your wages or bonuses or self-employed earnings reach $200,000, once they exceed $200,000, then on the excess, there's a 0.9% tax. And for married filing jointly taxpayers, well, when their combined earned income exceeds $250,000, that's when the tax applies. And if you're married filing separately, well, then the threshold is $125,000. All right? Now, there's an additional requirement here, too, on employers. Employers are required, this is for employees, employers are required to withhold this tax from employees' earnings. All right? It's not a tax on employers. It's a tax on an employee, but the employer must withhold it. Now, how does an employer know whether to withhold? Well, they look at each of their employees, and they have to determine whether those employers are earning more than $200,000. If an employee is earning less than $200,000, no withholding requirement. But anybody in excess of $200,000, they must do this withholding, okay? Now, let's take a look at an example. Actually, I'm going to do another example, not this one, and then I'll talk about this one. So let's say you have a married couple, all right? And we're going to illustrate the employer withholding requirement here. You have a married couple. Both spouses earn $150,000, all right? So their combined earned income on their tax return is $300,000. Because they each earn less than 200, their employers don't have to withhold. But when they file their tax return, they calculate the tax and they have to remit it with the return. So the tax would be the 150 of earnings per spouse, or $300,000 of earnings, less the threshold of 250, means $50,000 of their earnings are subject to the excise tax or the surtax on earnings. Now, in this example, we have John. He's a single taxpayer. He's self-employed. He's not an employee, and he has net self-employed earnings of $500,000. Well, he would compare his earnings to his threshold of 200, and he would have an excess of $300,000 over the threshold. That extra 300 is subject to the surtax on earnings, so he would have to pay $2,700 with his tax return of additional tax. And this would also affect his quarterly payments as well.
Now, the next one, 3.8% Medicare surtax on net investment income. Well, how does this one work? Yeah, stay with me here. The tax is at 3.8%, and it's on the lesser of your net investment income or the excess of your modified adjusted gross income over the threshold amount. And the threshold amounts are the same for this 3.8 Medicare surtax as they are for the 0.9% surtax. The only difference is this one also applies to estates and trusts as well. So the impact of this is it's basically, if you're subject to this, your marginal income tax rates are going to go up, okay? And I'll explain how this works in a second, but what are the potential tax rates going to look like? Well, currently we've got ordinary income tax from 10% to 35%. Long-term capital gains are at 15% currently, as is qualified dividends. Well, if the Bush tax cuts expire next year, as they're scheduled to do, and they don't get extended by Congress, tax rates are going to go up from 15% to 39.6% on your ordinary income. Long-term capital gains are scheduled to go back to 20%, and the big one is qualified dividends are going back to be taxed as ordinary income at a maximum rate of 39.6. So if you're subject to this tax, and you add that on to the rates that would take effect next year, you're looking at a maximum ordinary income rate of 43.4%. And the phase out of your itemized deductions for high income individuals is also scheduled to come back into play. So that could increase your rate by another 1.2 to 1.5%. So you could be at 44.6 to 45% marginal ordinary tax rate. You know, I don't know whether that's good news or bad news. So what's net investment income?
Okay, so let's remember here that this surtax applies on the lesser of your net investment income or the extent your income, your modified adjusted gross income, exceeds a threshold amount. So the tax only applies if you have net investment income. So what's net investment income? Well, it's interest on bank accounts and bonds. It's dividend income from mutual funds and stocks, annuity distributions, passive royalties, and it also includes income from passive activities. So if you're an investor in a partnership or an investor in an S corporation and you don't participate, you're just an investor, well, any income allocated to you from that business increases your net investment income. Also, if you sell that partnership interest or S corporation stock and you don't participate in the business, the gain on the sale of that interest increases your net investment income. All right? Now, what's not included? Well, wages, bonuses, self-employed earnings. It doesn't increase your net investment income. Any distributions from retirement accounts, taxable IRAs, 401ks, pension plans. And also, again, if you're an investor in a partnership or an S corporation and you participate in the business, well, any income allocated to you doesn't increase your net investment income. And if you sell that interest and also you're participating in the business, any gain on the sale doesn't increase your net investment income. And some other items that are excluded are tax-exempt interest from tax-exempt bonds, the tax-exempt portion on the sale of your personal residence doesn't increase your net investment income, and veterans benefits. Anything else? Social Security?
Any tax-exempt income.
Any tax-exempt income, yeah. Okay, so let's take a look at an example here. We'll actually do a few examples. So here, John is a single taxpayer. He has a salary of $100,000 and net investment income of $50,000. So he has net investment income, but because his modified adjusted gross income, $150,000, doesn't exceed his threshold amount of $200,000, there's no tax.
I don't know about any of you, but I can't wait to do these calculations when we start doing tax returns. Jane, here's another example. Jane's a single taxpayer. She's not employed, no earned income, no wages. All she has is, well, she has $225,000 of net investment income. So you look at her modified adjusted gross income, which is $225,000, over the threshold amount of $200,000. It exceeds it by $25,000. So the tax, the 3.8% surtax, is going to apply on the lesser of her net investment income or the excess over the threshold amount, which is $25,000. So in this example, she'd pay an extra $950 in tax.
Okay, in this third example, we have Tim and Tina. They're married filing jointly. They have combined earned income, combined salary of $300,000. Now that combined salary exceeds their threshold amount of $250,000. But because they have no net investment income, there's no Medicare surtax on net investment income. But I do want to point out one thing here. Remember, there are two surtaxes. There's the Medicare surtax on net investment income. There's also the Medicare surtax on earnings. In this case, because their combined salary is $300,000 and it exceeds the threshold of $250,000, $50,000 of their earnings would be subject to the surtax on earnings, okay?
Okay, another example. Here, Tim and Tina, they have a combined salary of $400,000, and their net investment income is $50,000. So when you go through the calculation, you compare the excess of their modified adjusted gross income of $450,000 over the threshold, and you get $200,000. You compare that to the $50,000 net investment income amount. So they're going to pay the surtax on the $50,000, resulting in another $1,900 in tax.
Okay, this example 5, Tim and Tina, they're still married. They've entered retirement, and they have pension income of $200,000. They have taxable IRA distributions of $150,000, and they have $25,000 of tax-exempt interest. Now, their modified adjusted gross income does exceed the threshold amount of $250,000 by $100,000, but remember, pension income, taxable IRA distributions, and tax-exempt interest are not net investment income, so there's no surtax in this case.
Yeah, one thing to remember with all these examples is if your income's below the modified adjusted gross income, you're never going to pay this tax. And if you're over that, but you don't have any net investment income, you're still not going to pay it because it's on the lesser of the two, okay? And the last example here, I mentioned this tax also applies to trusts. And the way it works is it's actually on the net income of the trust, the investment income of the trust. So in this example, the Tim Thomas Trust, there's $51,000 of interest and dividends and other investment income inside that trust. Now, the threshold amount for a trust is only $11,650. That's where the maximum ordinary income tax rate kicks in for a trust, which is really low. So this trust is over the threshold amount by $39,350. So they're going to pay the tax on the lesser of the $51,000 net investment income amount or the excess over the threshold, which is the $39,350. So they're going to pay an extra $1,495 in tax under this provision. Now, there's some planning you can do with trusts. If the trust would distribute all of the income to the beneficiaries of the trust, it would have no income inside the trust because it would be distributed out to the beneficiaries. So now that income still keeps its character as investment income. That would flow into the beneficiaries' tax returns, and then they would include that in the calculation on their return to determine whether or not they're subject to this 3.8% surtax on the net investment income. So, you know, if you have beneficiaries that aren't over the threshold amount and the trust allows you to make distributions, you know, and that is the right thing to do, you may want to do that, and you can avoid the tax. So there's some planning that you can do here. And Milan's going to touch briefly a little bit on some of just a few things that you may want to think about to plan around this tax.
Okay, so planning here. Well, there's two parts to it, really. And, you know, frankly, there could be as many planning options as there are people in this room, but it's two things. The tax is imposed if you have net investment income All right, so one of the things you can do is reduce your net investment income. Maybe switch your investments to tax-exempt investments. If you're an investor in a partnership or an S corporation and you don't participate, maybe in a year that you anticipate a large share of earnings, maybe that's the year you participate in the business, so it doesn't increase your net investment income. And the other way to do this is to reduce your overall income. Perhaps increase your retirement account contributions, perhaps setting up alternative retirement accounts for yourself or your business. Perhaps it's the year to consider a Roth conversion, or maybe tax-deferred annuities to help you leapfrog over a year or two where you might have high income. But basically what you should do here is you should talk to your financial advisors, CPAs, tax people, and try to plan for something like this. So Tony, 2014?
Okay, 2014. The tax changes that are scheduled to take effect here. I mentioned the small employer health insurance credit. That credit is scheduled to increase from 35% to 50% for qualifying small employers. And as I mentioned, that test, you have to go through the calculation to make sure that you qualify. And actually applies for 2 additional consecutive years beginning in 2014. And my understanding is you have to purchase your insurance through the exchange to qualify for the credit. So that's the first one. The next 2 are and probably should have changed the wording on there. It's now a tax on individuals. If they do not have the minimum essential health care coverage, they have to pay now a tax, and we'll explain what that is and how it works in a second. And the third one is the penalty, it's now considered a tax on employers that have at least 50 full-time employees that do not provide affordable health care coverage. They're going to be charged a penalty for not providing that coverage. So how does the individual penalty work?
Tony, I would think the word tax and penalty are synonymous. Oh yeah, you can't deduct a penalty. Okay, so the individual tax, the individual penalty, how's it calculated? Well, if you don't maintain minimal essential health coverage, you have to pay a penalty. And the penalty is the greater of a flat dollar amount or a percentage of an individual's household income. A percentage of an individual's household income above a threshold amount. Basically, that threshold amount is the filing threshold for filing a tax return. And household income is, the income of yourself, your spouse, and everyone who's on your tax return as a dependent. So if I have a dependent child that earns some money, I would include their household income as well. All right? Now, let's take a look at the amounts. For 2014, the flat dollar amount is $95, and it goes up. 2015, it's $325, and it goes up to $695 for 2016 and beyond. And beyond, it's indexed for inflation. And this penalty, this flat dollar amount is per person. So it's per the taxpayer, per the spouse, and any dependents on the return as well. So if there were 4 people, you multiply these numbers by 4. Now I said it's the greater of the flat dollar amount or percentage of earnings. And the percentage, as you can see there, 1% of your household earnings for 2014. And it goes up. So let's take a very basic example here. Let's say there's a 26-year-old individual in very good health. They decide, you know what, I don't need to pay for health insurance. I'm in great health. I'll be just fine. And they earn a salary of $60,000. Now, the filing threshold, let's take back a little bit for that. So let's say the amount that would be subject to the percentage is $50,000. Well, you would compare the $95 penalty to 1% of $50,000 or $500. So in this case, the individual would pay $500. And it's calculated monthly. So if for half the year there's no insurance, then you'd pay the penalty, and the penalty would be half. But for the remainder of the year he had insurance, you'd just take that number and multiply it by 1/2.
Okay, now bear with me on this one. This is the penalty for employers not offering affordable coverage beginning in 2014. So there's a couple slides on this, and I tried to do it in a little flow chart so I could explain it a little bit easier. But the starting point is, as an employer, do you have at least 50 full-time equivalent employees? So if you don't have 50 employees, the penalty's not going to apply because you're a small employer. And what you want to do is at least you want to make sure, if you have under 25, you want to make sure at least you go through the calculation to see if you qualify for the small employer credit, okay? What is 50 full-time equivalent employees? Well, I hate to tell you, but the calculation is not the same as it is for the small employer health care credit. If you can believe that. So what's a full-time equivalent employee? Well, it's an employee who works on average 30-plus hours a week, and it includes the total hours worked each month by a non-full-time employee divided by 120. And you can exclude seasonal employees. So for example, if you're in the retail world and you have people coming in for a couple months during the holidays, you can exclude those from the calculation. But basically for your non-full-time employees that work on average over 30 hours a week, you take all the hours for all the other employees, and this is by month, and you divide by 120 to calculate your full-time equivalents. So you add them all together, and if you're over 50, you've got to provide the coverage. If you're not, you don't. So what happens if you are over 50? Now the question is, do you as an employer, or does the employer offer coverage to your workers? Well, if the answer is no, and you had at least one of your employees receive a premium tax credit or cost-sharing subsidy in the exchange, then the employer is subject to the penalty. And they're not just subject to the penalty for that employee, you're subject to the penalty for all your employees. So the calculation is, you add up all your employees, subtract 30, you get 30 sort of as like the safe harbor, and the excess, the penalty is $2,000 annually. Again, it's a monthly penalty. How you calculate that, I mean, I'll defer to these guys when they talk, but I don't know how you calculate that on a monthly basis. The compliance on this is not simple, let's put it that way. But let's say if you did not have any employees that went to the exchange and got a premium tax credit or cost-sharing subsidy, there's no penalty. I think that's probably highly unlikely. Now, let's say you do provide insurance to your employees. Well, is it affordable? Does the insurance pay for at least 60% of the covered health care costs under the plan? Well, if the answer is no, the employees then can go choose to buy coverage on the exchange, and they can receive a premium tax care credit. If they do that, then the employer is subject to the penalty on the employees that went to the exchange and got the credit. If you do provide at least 60% of the health care coverage, but you've got employees that have to pay more than 9.5% of their family income for the employer for the coverage, then they can go to the exchange and be covered under the exchange and receive a premium tax credit. If that's the case, then the penalty applies. So if you're providing coverage and you're paying 60% or more, and the employee share is less than 9.5% of their household income, there's no penalty. But if you don't meet that requirement, there is a penalty. Okay, and the penalties. This is another great calculation. It's $3,000 annually for each full-time employee receiving the tax credit, but the limit is the calculation under this penalty calculation. And I'm not going to go into a lot of details to try and explain how that works. I'm just kind of curious, once the regulations come out, how this is all going to get administered. So that's sort of an overview of how the penalties work for employers with 50 full-time equivalent employees.
Okay, our last tidbit here. This is a tax change coming into effect in 2018. And this change is really, it's to generate revenue to help cover the uninsured. It's an excise tax. It's a 40% excise tax imposed on insurance companies that are offering Cadillac plans that have coverage costs that exceed $10,200 for individuals and $27,500 for families. Basically, this excise tax is imposed to make these plans unattractive to buyers. So with that, I think we're done. Todd, I'll turn it back over to you. Thank you.
Okay, thank you, Tony and Milan.